Have you ever sold a stock too early and watched it soar and felt that pang of regret? What if I told you that regret itself might predict future returns? What if you could profit from other investors' reluctance to buy back a rising stock? In the next few minutes, you'll learn how an obscure behavioral bias called the repurchase effect could form the basis of a 23% annualized trading strategy. Hi everyone, quantifiedstrategies.com here. On this channel, we dig into trading strategies, psychological biases, and how to turn them into systematic approaches. Today's topic is a fascinating blend of behavioral finance and quantitative strategy. Based on a research paper and the blog summary quantifiedstrategies.com, we'll explore how investor regret, specifically the reluctance of investors to repurchase stocks after selling them at a gain, creates a predictable pattern you can trade. We'll break down the bias, the strategy rules, real-world evidence, and how you might apply it. The big idea is this. When an investor sells a stock for a gain, they often experience regret about missing out on further upside. That regret can make them less likely to buy the same stock again, even if it's rising. This behavioral pattern is called the repurchase effect. According to the research paper, the researchers define a measure called repur, which quantifies how much buying pressure a stock lacks because past owners are avoiding repurchases after gains. So stocks that show high repur, that is strong avoidance by prior sellers, tend to have lower future returns because investor demand is muted. On the flip side, stocks with low repur, that is little avoidance, more repurchases, are relatively neglected by regret and may be poised for better returns. Here's how the trading strategy is defined, in simplified form. At the start of each month, rank stocks on the repur measure. For example, lowest decile equals P1, highest decile equals P10. Go long the stocks in the lowest repur decile. P1 equals low regret, high repurchase likelihood. Go short the stocks in the highest repur decile. P10 equals high regret, low repurchase likelihood. Hold the portfolio for 1 month, since the pricing impact is concentrated in the first month after formation. The effect weakens beyond the first month. According to the results, on an equal-weighted basis, the long-short portfolio produced an annualized abnormal return of over 23%. On a market-weighted basis, it was about 11%. What's going on under the hood? The article argues the effect is behavioral rather than purely mechanical. Some key points. After a sale at a gain, investors may avoid repurchasing due to regret over missing further upside. They think, I should have held on, which reduces demand for that stock. This reduced demand translates into muted future price performance, all else equal. The effect is stronger under certain conditions: high investor sentiment, high market uncertainty, volatility, stocks with low liquidity, smaller investor base. The research shows it persistently works even after controlling for familiar anomalies like short-term reversal and the disposition effect. Also validated in the Chinese market, where retail trading dominates, with weekly rebalancing and even stronger magnitudes. Here are some practical thoughts if you're thinking of turning this into a trading idea. Data. You'll need a dataset that has information about trading volumes, past sales, and repurchases by investors, or a proxy for that. The original paper creates a detailed stock-level measure of repur.
Universe. The effect may work better for stocks with more retail involvement, higher limits to arbitrage, and higher volatility or uncertainty. So you might consider narrowing to small or mid-cap or illiquid stocks.
Portfolio size and weightings. The original result was equal weighted. If you shift to value weighting or large caps, the effect is smaller. Overlay filters. You might further filter by high sentiment periods or high volatility environments where the effect is amplified. Backtesting. Because this is a behavioral effect, it could degrade over time, so a fresh, out-of-sample backtest is advised. Behavioral biases are fragile. Once they become widely known, they can diminish. The data to compute repur may not be readily available for all markets or for all stocks. Shorting constraints. In some markets, shorting stocks or illiquid stocks may be costly or difficult. It links psychology, regret, with quantifiable measures. Rare to get such a clean behavioral angle with significant returns. It offers a return stream that is distinct from typical value, momentum, or size factors, so it may add diversification. If you enjoyed this breakdown of the regret-based trading strategy, hit the like button, subscribe, and ring the bell so you don't miss future episodes where we dig into another trading bias or mechanical system.